Okay, let's break this down with Aditya Saraswat, MENA Research Director at Rystad Energy. Great to have you on. So we're seeing these mixed signals. We've got increased levels of diplomacy on one hand. We've got the US blockade of the Strait of Hormuz on the other. I mean, it's pretty choppy waters at the moment. How do traders navigate that uncertainty?
Traders, as we speak, aren't waiting for the clarity. They are pricing in the worst case and hedging accordingly. And the numbers tell the story, right? Because the Brent futures sit around $94 per barrel, reflecting diplomatic hope. And dated Brent, the physical spot price, hit an all-time high of $144 per barrel last week. So there is a $35 per barrel of premium over futures, and that gap is essentially the market's verdict on the actual supply situation. And we can't bet on one outcome when both de-escalation signals and blockade reinforcements are running simultaneously. Options markets show that topside volume heavily bid, tankers rate are spiking, and hedging windows are shortening. So as we speak, the insurance is being bought first by the market, and this is the trend that we will continue to see when until there is a meaningful, durable resolution seen of this conflict.
Aditya, one thing we can do, though, is try to ascertain what is happening in real time. So the US says it has its blockade in the Strait of Hormuz fully in place. So in terms of what we see with our eyes, in reality, what will that mean for global supply?
Well, that blockade is real and significant, right? Because it essentially takes out the 20% of global oil and 25% of LNG transiting through Hormuz daily before the conflict out of the picture. And that strategic logic requires a negotiated exit. And that is a diplomatic and militarily problem, not something that energy market can solve on its own. And the question now is how much of economic damage accumulates on both sides before the exit is found. The US has the naval assets to maintain the blockade. We are hearing about select vessels passing through, but that does not tell you any better story, because effectively most of the ships, almost all of it, are stuck behind the Strait of Hormuz. And sustaining it is essentially meaning absorbing higher energy prices, managing allied dissent. We see that NATO has refused to join, and holding the line against the Iranian counter moves in the broader region. So it's a toughening posturing from both sides, and we will see how this play out until the 22nd of April ceasefire deadline.
Aditya, I mean, it's pretty obvious what Donald Trump's plan is here. He's trying to squeeze Iran financially. I mean, as I understand it, more than 90% of Iran's seaborne trade passes through the Strait. So Trump's really trying to squeeze them financially. I suppose the question is, how long could Iran survive in those circumstances? How much pressure is it under?
The economic squeeze is severe and accelerating, right? But Tehran has been rehearsing for exactly the scenario for over a decade, which means that the pressure is real, but the timeline to politically effect is not straightforward. We have seen that Iran has faced cascading sanctions since 2012, 2013. And since then, they have developed a dark fleet and shadow operating system to divert their flows. And that essentially has worked out well because the strait was still functioning. But now when there is a physical stoppage in play, most of their finances, that essentially puts a major piece of a pie in their domestic budget, is at risk. But then again, we have to be mindful that these are immediate sort of blockade, and the market is expecting a resolution soon. The couple of weeks of blockade is something the domestic economy can absorb, but sustaining it on top of increasing debt, increasing inflation levels, arrears, etc., will be very tough to digest. And in terms of domestic demand, both oil, liquids as well as gas demand will be harder to meet if it sustains for, let's say, by end of this year, because of the underinvestment. Most of these